In this lesson, we will cover concept to financial statements, and then we will calculate depreciation on vehicles. We will also calculate profit and loss on the sale of an asset. Then we will do a statement of comprehensive income that is also integrated with a statement of financial position. This paper is a full paper. When it comes to financial statements, it really integrated everything and covered everything, starting from the concepts to calculating your depreciation and your profit on depreciation. But most importantly, what I like about it is that it integrates the statement of financial position and the statement of comprehensive income, so that you see how to deal with this information when it is put in one information, but you need to know which one goes to the statement of comprehensive income, which one goes to the statement of financial position, and how can one information be recorded in the statement of comprehensive income, and how will it now differ when you take it to the statement of financial position. So it is really a full question, and getting started with question 1 of this question paper, we are dealing with financial statement concepts. It says choose one concept in each of the following descriptions. We have some descriptions in a box, and we are going to match them pretty much in a fill in the missing word. 1.1.1 says consumable stores on hand. Consumable stores on hand, where do they fall under? Are they net, salary, operating efficiency, non-current assets, gross salary, current assets, or risk and gearing? Non-consumable stores on hand, they go under inventories, and inventories are part of current assets. So our answer to 1.1.1 is current assets. 1.1.2, an employee was omitted from the salaries journal. His salary has been credited to the trade and other payables in the statement of financial position. So in the statement of financial position, what we record for our salaries, we record net salaries. You will see that in the descriptions we have been given net salary and gross salary, so it is up to you to know which one we record in our books. In our books, we will record a net salary. Why? Because contribution also have a separate line item, so we need to take the contributions out of the salary, then we will be left with what we call a net salary. So net salary is pretty much gross salary minus contributions or minus deductions. So the deductions will be not recorded in there, only the net salary. Then 1.1.3, the way in which a company manages loans or borrowed capital. The way we manage loans or borrowed capital, that's what we call risk and gearing. Risk and gearing, if you have seen this term before, just means how are we being able to pay for the loans that we take? Are we able to cover them, and are we able to cover them on time without incurring any penalties? 1.2 is where we get into our financial statements for KC Limited. You are provided with the information for the financial year ended 28 February 2023. In the required, they say complete the following for the year ended 28 February 2023, starting with 1.2.1, which wants you to calculate depreciation on vehicle. So we are going to look at our information for vehicles. So in information B, we have information on depreciation of vehicles and equipment. So for this question, we are focused on the information on vehicles. The first bullet says the business has 2 vehicles. The following details appeared in the fixed asset register on 1 March 2022, meaning at the beginning of the year. We see that we have vehicle 1 and vehicle 2. The cost price of vehicle 1 is 240,000. It has an accumulated depreciation of 225,000 and a carrying value of 15,000. Vehicle 2 has a cost price of 312,000, a carrying value of 62,400, and it has a carrying value of 249,600. 100. And then right under the information about equipment, we will find on the rates on which we are going to depreciate our vehicle. It says the business provides for depreciation on fixed asset as follows. The first bullet says on vehicle at 25% per annum on cost price. So we know that when we are using cost price or depreciating on cost price, our formula for depreciation is equals to original cost multiplied by the rate, meaning the 25% that has been given to us, over m over 12. M represents the number of months in which we had our vehicle on hand. So when we calculate depreciation for vehicle number 1, we have cost price at 240,000. We are going to multiply that with 25%, which is our rate, multiplied by our m over 12. We had the vehicle for a full 12 months and over 12, and it shows us that our depreciation is 60,000 rands. But you will see in the information they told us that the carrying value of our vehicle is 15,000 rands, meaning that this vehicle is fully depreciated. So we cannot minus 60,000 when a vehicle is left with a value of 15,000. The only thing that we can minus is that 15,000, but not all of that 15,000. What we can do is say our depreciation for this vehicle will be 15,000 that is remaining. But because we cannot depreciate an asset up to 0, what we do is we are going to leave it at the value of 1 rand. 1 rand represents the fact that even though this vehicle is at its scrap value, but you can still see it, it's still a physical item, so we have to leave it at least that 1 rand, because if we minus the full 15,000, we are saying that this vehicle doesn't exist, meaning it's not there. The only time we can minus this 15,000 in full is to say that this vehicle is not there. Either it has been dismantled, it doesn't exist anymore. But so long as it exists, even if it's at its scrap value, it should be represented by 1 rand. So we should take out at least 1 rand out of this 15,000, meaning that for vehicle 1, our depreciation is now 14 rand, 14,999. For the second vehicle, they tell us right under the information in our box there that vehicle 2 was sold on 1 July for 210,000 rands cash. So when we are calculating depreciation for this vehicle, we are going to keep in mind that it was sold during the year. So if it was sold during the year, it then means that we do not have it for the full 12 months. So going back to our formula, we are going to say our original cost of 312,000 multiplied by 25% multiplied by now. Our M is a different amount because now it was sold on 1 July. So if it was sold on 1 July, you can count with your fingers. Our financial year started on 1 March 2022. So that means we had it for the full month of March, April, May, June, and it was sold on the 1st of July. So we are not going to count July. So that means we had it for a full 4 months. So 4 over 12. And our depreciation is 26,000 rands. So the M here is 4 and our depreciation is 26,000 rands. Meaning that our total depreciation in the answer section will be 40,999. Next, for that same vehicle, we are calculating our profit and loss on its sale. Now, when it comes to the sale of vehicle, what we want to know is, did we sell at carrying value or at less than carrying value? So we have profit if we sold at more than carrying value. So we need to know the carrying value of our vehicle at the time we were selling it, and if we sold it at more than carrying value, we will have what we call a profit. But if we sold at less than carrying value, then we will have a loss. So the first thing that we need to do is to calculate what was the carrying value of this vehicle when we were selling it. We were given that carrying value before we depreciated vehicle 2 in information B was 249,600. And then in the previous question we did the depreciation at the time that it was sold, so we are going to minus that depreciation so that we have a new carrying value, and it's a carrying value of 223,600. Now in the information they told us how much they sold the vehicle to for on 1 July 2022. They said it was sold for 210,000. So you will see that 210,000 is less than this amount. So that means that we made a loss. So how much is my loss? I'm going to take my carrying value minus the amount that I sold it for, and it gives me a loss of 13,600. The question said here that you will circle your choice. Our choice is a loss, so we are going to circle loss. 1.2.3 wants us to complete the statement of comprehensive income. You will see that the first few areas have already been shaded. We don't have to put in cost of sales, gross profit. We are starting with our other incomes. Our discount received has already been entered for us, and they want us to start with a rent income, which has already been given to us in our information as 165,000 rand 600. And then when we go to our information, we look at information D, and it says rent received from a tenant included the rent for March and April 2023. The rent was increased by 10% per annum from 1 January 2023. So it means that we will need to subtract the rent for March and April out of the 165,600 that we have been given. So to determine the rent for March and April that we need to subtract, we are going to do this using the percentage format. So they're telling us that from 1 January 2023, rent was increased by 10%. So we are going to assume for the first 10 months of the year, that is from 1 March 2022 up to 31st December 2023. For those 10 months, for the first 10 months of the year, we are going to assume that our rent had no increase, meaning that our rent was at 100%. And then for the last 2 months of the year, which is January and February, our rent had already been increased because it was increased in January. So that means that our rent for those 2 months was at 110%. And then we are also going to say in our rent amount, the way they told us, March and April were already included, which is the months that do not belong to this financial year. Hence, we put them in their own separate bracket. It's 2 months. They are also at 110%. And everything is all what gave us that 65,600 that we see in our extract of balances. So we are going to solve and calculate what is in our brackets. 10 times 100 will give us 1,000%. 2 times 210 will give us 220%, and so will this 2 times 220 will give us 220%, and it is all still for 165,600. We put all of these numbers in a calculator. Don't put the percentages, just 1,000 plus 220 and 220. It will give you 1,440,000 1440% is equals to still 165 600. And then we are going to use our favorite formula in accounting, which is the unknown over known format, meaning what we are looking for over what we have. Now, what are we looking for? We are looking for the rent for March and April. March and April, remember, they were represented here, meaning they are represented by the last 220. We don't know how much it is. That's what we are looking for. So this becomes our unknown. So our unknown is this part. So you're going to call it the unknown. And then our known becomes this. Why do I say it's known? I know that 1440% is represented by 165 600. So that means that this I do know. So this becomes my known. So then my unknown is 220 all over my known, which is 1440, everything multiplied by 165 600, and it will give me a total of 25,300. This 25,300 is the amount that represents May, March, and April, and that's the amount that I need to subtract from my 165 here. So I'm going to minus 25,300. My rent income becomes 140,300. For our next line item, we are going to look at our physical stock taking and information C. It says a physical stock taking on 28 February 2023 revealed a value of stock on hand as 79,900. When you go to information A, you will see that information A shows us that our trading stock is 79,750. So that means we have a trading stock surplus. If you haven't gotten the hang of your trading stock surplus and your trading stock deficit yet, you have a trading stock surplus if the one that you see in your information, meaning a physical stock taking, your physical stock taking is higher than the one that is in your record, meaning in information A. So whenever you have in information A, they will give you a list of balances or a trial balance. So whatever that means, that's what is being recorded in the books. So whether it's from a list of balances, whether it's from a balance sheet, whether it is from a trial balance or a list of balances in the ledger, that is the records, and those records shows you what is recorded. So if what's recorded is lower than what has been physically counted, meaning physical stock count is when you get into the storeroom and you physically count one by one what is on the shelves. So the shelves have revealed that we have more than what we thought we had in our record, so that gives us a trading stock surplus, which means for a trading stock deficit, it is the opposite, meaning in our records we would have recorded an amount that is higher than our physical stock taking. So in this scenario, you will see that our physical stock taking is higher than the amount that is in our records. So our physical stock taking shows 79,900, whereas our records show 79,750. So you subtract them and you get a surplus of 150 rands. So 150 rands is my surplus. The last line item for our other income is our bad debts recovered. You will see in information A we have been given bad debts recovered at 550, but we also have information E that gives us more information on a bad debt recovered. It says a debtor Z Bender whose debt had been previously written off paid 150. The bookkeeper incorrectly credited the amount to debtors control account. this is not supposed to go to debtors control. Debtors control account means that they took more goods of credit of 150 when actually they were coming to pay their debts. So it wasn't supposed to go to our debtors control. It was supposed to come back to bad debts recovered. So we are going to add 150 there, and our bad debts recovered total is 700. From there, we move on to our operating expenses, and for the salaries, audit fees, and stationery, they have already entered those amounts for us. What we need to do is start with insurance, which is given to us at 22,800, and then we have information G that says an annual insurance premium of 15,600 was paid on 1 October 2022. So it says that it was paid, meaning that we can safely assume that that 15,000 is already included in this 22,800. What we need to do, since it was a premium that was paid for a 12 months that starts on the 1st of October, meaning if the 12 months starts on the 1st of October, it is most likely going to pass our financial year. Our financial year ends on 28 February 2023. So whatever is beyond 28 February 2023 needs to be subtracted out of that amount. So we are going to say we have been given an annual premium of 15,600. This is annual, so we need to know how much it is per month. So we are going to divide it by 12, and it gives us a monthly payment of 1,300. And then we are going to say how many months do not belong to our financial year. So they're saying it started on 1 October 2022. So from 1 October 2022 to 28 February 2023 is going to be 5 months. That is our financial year, meaning the rest of it, which is the last 7 months, does not belong to this financial year. So this 7 months is what we are going to subtract, and this 7 months is 1.3 times 7 will give us 9,100, which is what we are going to subtract here. And our insurance is 13,700. Next, we have our bank charges, and we are given information H, and it says the bank statement was received after the above balances and totals were recorded. The following still needs to be taken into account, which is bank charges of 140 rands. They are simply just going to be added because they were not added to begin with, and that gives me bank charges total of 5,910. And then the next one is our directors fees. Our directors fees has been given to us in information J, and it says the company has 3 directors earning the same monthly fees. One director was only appointed on 1 June 2022, and he still needs to be paid for February 2023. So what we need to know is how much is each director being paid, so that we can add just 1 month of that payment to this amount in the income statement. So if we can just know how much they get paid per month, because they all earn the same amount. So if we can just figure out how much does one earn per month, and then we will take 1 month pay and add it into that total, and our problems will be sorted. So to figure out how much they earn per month, we are going to divide this by the number of months and the directors that have been given to us. So it's just a division problem. So we are going to divide. We are going to say, when we divide, we can't just divide by 3 or divide by 3 times 12, because first of all, The directors, even though they earn the same amount of money, they were not paid equal months. What do I mean by that? The third director was only employed in the middle of the year, so it means that he does not or she does not have the full 12 months. And then on top of that, not only was she employed in the middle of the year, it or was he employed in the middle of the year, he also did not receive his last month's pay. So what we need to do is to say that for the first director we have a full 12 months. Add that with the second director, we have a full 12 months. Now, our problem is the third director. The third director, he was employed in June. So we are going to count how many months is it from June up until January. Why January? Because I'm not counting February. He was not paid for February. That's what we are trying to figure out here. So from June, July, August, September, October, November, December, January, that's 8 months. So that means this director has 8 months. So that means that this 768,000 will now be divided by 12 plus 12 plus 8, which is 32 months, and it's going to give me a total of 24,000 rands. This is what each director earns per month. So in our income statement, we are going to add 24,000, and it gives us a total for directors fees of 792,000. For our next line items, we are going to add the information that we have already calculated in 1.2.2, starting with the depreciation of our vehicles, which was 40,099. I'm putting it in bracket because remember we also have equipment, so we need to go and calculate depreciation for equipment. When we go back to information B, it says KZ Ltd bought new equipment on 1 March 2022 for 115,000. This transaction was properly recorded. The depreciation for the year of 17,250 was accurately calculated and recorded. So we see that the depreciation for our equipment has been recorded for us at 17,250, and that means our depreciation for the year total is 58,249. And then we also remember that we calculated a loss on the sale of a vehicle 2. We calculated that loss and it was 13,600, so we are going to also insert it there. Next we have our bad debts. In information I, a debtor V Medrick has a credit balance of 1,350 in debtor's ledger, and it must be transferred to his account in the creditor's ledger. So our bad debt is 1,350. And then we also have provision for bad debts. Provision for bad debts, and that is in information F. It says provision for bad debts must be adjusted to 3.5. Now you will see in our information A that our bad debts provision for bad debts is at 3.1. So that means that for it to be 3.5, we just need to add it. We don't have to put in the full 3.5. We would be putting the full 3.5 if it said added by, but since it says added to, it means that we need the 3.1 to change from 3.1 to being 3.5. So we just need to add what is remaining. How do we calculate what is remaining? We will take the 3.5 and minus the 3.1, and you will see that it is only short of 400. Next, we move on to our information under operating profit. They have already shaded operating profit and interest income for us, so we don't have to enter that. What we have to enter is profit before interest expense, but because we don't have these two informations, it is we are unable to create this, so this will be our balancing figure. So we will have to skip it for now and go to our interest expense, fill in everything, and then we will come back to it. So we go on to our interest expense. Our interest expense has been started for us at 1,300, and we are going to go look at information K because this is interest expense. So usually it is our interest on loan. Information K says interest is capitalized on a mortgage loan. The annual loan statement from Pride Bank reflected the following. They have given you the statement from Pride Bank. You will see you have balance at the beginning of the year. You have interest that is capitalized, which is a question mark. That's what we are calculating now. And then you have your repayments, which include interest, and you have your balance at the end of the year. So to calculate your balance, your interest, when you have been given such information, what you need to do is usually use a formula for yourself, a formula that usually works, especially when you have been given this information exactly as it is, like this: balance at the beginning, repayments that include interest, and balance at the end. What you do to calculate your interest, you will say interest is equals to balance at the end, then you will minus, open bracket, balance at the beginning minus repayments. These repayments must be the repayments that include interest. Otherwise, you will have to use a different formula when it is like that. We will find a question that is like that in future for you to be able to use it. But so long as you are given information with repayments, which is usually how it is given, because repayments are supposed to include interest. So it's very rare that you will find a question that excludes a repayment, interest in repayments, because repayments are supposed to be added interest to them. You pay a full amount to the bank. So when it is given this way, which is it's in its natural order, this is the formula that you will use. So we will go on our calculator and we will use that information as we have been given. So balance at the end is 369,600, and then you will minus, open bracket, balance at the beginning, which is 422,400, minus 116,160, close bracket, and it gives you a total of 63,360. So you will add 63,360, and your total for your interest expense is in bracket, remember, because it's an expense. So 64,660. We cannot for now calculate our net profit before tax, because again we do not have our net profit, our profit before interest expense. So what we are going to do is we are going to figure out our income tax, and then we are going to work our way back to figuring out our net profit before tax, and then after getting our profit before interest expense. To calculate our income tax, we are looking at information M. It says income tax for the year is calculated at 30% of the net profit. The net profit after tax is 1,050,450 after adjustments. So if you notice that this is net profit after tax, it has also been entered to us in our statement or as the net profit after tax right at the end. So we cannot simply use the formula that we use usually when we have a net profit before tax, because if we have a net profit before tax, we would just then say net profit before tax multiply by 30 over 100. It will give us our income tax. But in this scenario, because we have a net profit after tax, meaning that what we need to do now is start with that net profit after tax, multiply it by the, again, no unknown over known formula, what I'm looking for over what I have. What I'm looking for is the 30% over what I have. What I have now, this is no longer a 100% because tax has already been taken out of this amount. So that means what I'm remaining with there is a 70%. So whenever you are dealing with a net profit after tax, you say 30 over 70 instead of 30 over 100. 30 over 100 is for net profit before. When it's after, it's then 30 after 70, and it gives us our income tax of 450,000 in bracket because it's an expense 195. And then from there we are going to use these two amounts to calculate our net profit before tax. So to get our net profit before tax, we are now going to say the profit after tax plus the tax itself, and it gives me 1,500,650, and that's what goes on there. And then we are going to then use this amount added with this interest expense to get our profit before interest expense. So this same amount we are just going to add to it our interest expense, which was 64,660, and it gives us 1,565,310 as our profit before interest expense, and that would be our statement of comprehensive income incomplete. Then we move on to our statement of financial position. Our statement of financial position starts with a fixed assets. In our fixed assets, we know that we have land and building. So when you go to information A, you will see that land and building is at 1,810,000, and then we will add vehicle. Remember, in information B we have already calculated it. We had two vehicle. The first vehicle has a carrying value of 1 rand because it was fully depreciated, and then the second vehicle was sold. So that means that we are left with that one vehicle that has a value of 1 rand. So its carrying value is 1 rand. So we are going to add 1 there. And then our equipment, when it comes to our equipment, they in information A, you see that our equipment had a carrying value of 115,000 at the beginning of this year, and then we are going to minus the depreciation for the year that we found in our information B for equipment, which was 17,000 and 250. So that means the carrying value of our equipment is 97,750. So in total our fixed assets are 1,907,751. Then we do not have any fixed deposits that they want us to enter. They want us to move straight to our inventories. For inventories, we are going to record what is in our physical stock count, because that is the true representation of what we have as our stock on hand, and that was 79,900. So for trade and other receivables, we start with 71,829 and then we go back to information E. In information E, they told us a debtor Z vendor whose debt has previously been written off paid 150. Remember, this was our bad debts recovered, but they said the bookkeeper incorrectly credited, meaning he minus the amount in debtors control. He was not supposed to minus the amount in here. That amount was supposed to go to that bad debts recovered, as we did it in the statement of comprehensive income. So because he minused it in here when he was not supposed to, we need to add it back to show that this amount was never supposed to leave in the first place. So you're going to add 150, and then because it's trade and other receivables, we need to record net trade debtors. So net trade debtors, meaning that our debtors control amount, meaning these two amounts which make up our correct debtors control, it needs to be subtracting provision for bad debts. So provision for bad debts, they told us it was supposed to be 3.5 in information F. So we're going to minus 3.5 from information F. And then we also have a debtor in information I who was a debtor V metric who has a credit balance of who has a credit balance of 1,350 in debtors ledger. It must be transferred to his account in the creditors ledger. So meaning that in the debtors ledger, this amount is a minus. And so we need to take it out of the debtors ledger and take it to the creditors ledger. And since it is a minus, we need the effect to be 0 in the debtors ledger so that this amount will be reflected in the creditors ledger where it's supposed to be. It cannot be in two statements, otherwise it will be double accounting. So because in the debtors ledger, it's already a minus, to make this thing a 0, we will need to do that by adding. So we're going to add 1,350. 1,350 will give us a total effect of a 0 so that we don't have this amount in our debtors ledger anymore. And then we are going to remember that for insurance we have an expense that is prepaid, meaning we paid it in advance, and anything that we pay in advance is our asset. So the amount that we subtracted there, which was 9.1, we are going to add it here. And then lastly, in our information A, we have a deposit on water. Deposits are also like amounts paid in advance. We add them, they are an asset to us. Basically, the logic behind it is if I decide to leave or I decide I don't need the services anymore, they will have to refund me because I haven't received the services for these amounts yet. So a deposit of 1,500, you will see it in your information A. Then your trade and other receivables total will be 80,429. Then for our total assets, we cannot get our total because we don't have our non-current assets and our current assets that would be added together to find this amount. However, since this amount is the same amount as our total equity and liabilities, whatever we get here, we are going to put here. So that means we need to go to our equities and liabilities section so that we can get our total and put it there. So when we get to our equity and liabilities, we start with shareholders equity. We see that ordinary share capital has been entered for us at 1,320,000. We need to calculate our retained income. For our retained income, in information A, you will see that we have a question mark, so that means we are going to deal with that as a balancing figure. If we can find our shareholders equity, then we will take the shareholders equity minus ordinary share capital, and we will get retained income. So how do we get our shareholders equity? To get our shareholders equity, we are going to use information N, the last information, and it says a net asset value on 28 February 2023 is 120 cents per share. So we know that it's 120 cents per share. What we just need to know is the number of shares that we have at the end of the year, and we go back to information A to find that information, and right next to ordinary share capital you will see they show us that we had 1,200,000 shares that we are going to multiply at 120 cents. You are going to say 120 cents is the same as 120 over 100. That will give you your 120 cents, and that is 1,440,000, and you are going to take this amount minus our ordinary share capital of 1,320,000, and it gives us a retained income of 120,000. Moving on to our non-current assets, we have a loan from Pride Bank that is in information K. So for our loan, we just record the balance at the end, which is 369,600, and we are going to subtract current portion of loan. This is the only thing that you do when it comes to non-current assets. Take balance at the end and minus what we call current portion of loan. What is the current portion of loan? The current portion of loan is the repayments that exclude interest that we are going to pay next year, not the ones we paid this year, the ones that we are going to pay next year. They have to give you that information. Usually they will tell you the amount, or they will just tell you a statement like they did when we look at in information K, bullet number 2. It says the total amount for repayment of the loan will remain the same over the next financial year, meaning that next year what we are going to pay will still be 116,160. But here for current portion of loan, we don't want to record the full 116 because that 116 includes interest. We want that amount excluding its interest. So it's 116,160. We need to subtract the interest, and then we will get our current portion of loan. So how much was our interest? Remember our interest on loan. So you can go back to your statement of comprehensive income and remember that our interest was 63,360. So when you minus it, you get 52,800, and that is your current portion of loan. Current portion of loan is subtracted from your non-current assets. Why? Because it will be added to your current assets. So remember, this amount will now need to be added here when we come to the current liabilities. Remember, you will notice we were going to record this amount. So after you subtract that for your non-current liabilities, you are left with 316,800, which is the same total. Remember your totals. Whenever your totals are not shaded, it means that you are going to remember to have to record them, because usually these are free operational max. So you're going to record it here and record it there to show that that is all that you have for your non-current liabilities. Then we go to your current liabilities, and they start with a trade and other payable. Trade and other payables, we are going to go back to information A, and in our information A we will find our creditors control. Creditors control is at 16,680, and then we are going to add information I, where the data control amount, there was a credit balance of 350 that had to be transferred to a creditor's ledger. So we subtracted it, or we made it a zero in the trade and other receivables. We are going to add it in here. Add 1,350. And then remember that director that we did not pay for in information J, the last amount that we had to pay. Remember information J of director's fees, we are short 1 month for the last data, and that 1 month we calculated it to be 24,000. We are also going to also add the rent that we received in advance. Remember, when somebody gives you an amount in advance, it means that you are in their debt. So for those 2 months, remember, we came to 25,300, and that is relating to information D. So our total then for trade and other payables becomes 67,330. Then we are going to record our current portion of loan. Remember that current portion of loan, I said you're going to have to remember it when you get here. So this is this amount. You're going to take it exactly as it is, 52,800, and then from there you are going to calculate your SARS income tax. SARS income tax, you are going to say that you have been paying some provisional taxes for the year, and you want to make sure that those provisional taxes that you paid for the year are actually what you were supposed to have been paying. Remember what you were supposed to pay for this financial year. We calculated it to be 450 195 when we were doing our statement of comprehensive income. And then when we go to information A, you will see that for SARS income tax, what you paid as provisional tax is 350 145. So it means that this amount is short. So whatever is short to make it 450, that's what you have as your SARS income tax that goes in your statement of financial position. And when you put it in your calculator, it will give you 100,050. Then we have shareholders for dividends that has been given to us in information A as 444,500. And then lastly we have our bank overdraft. The bank overdraft has already been entered for us as 90,040, and then we are going to remember information H, which was about our bank charges. Our bank charges are going to go here with our bank overdraft, add them together. 90,040 plus 140 is 90,180, and then you will add everything that is in your current liabilities, and it gives you a total of 354,860. And now that we have this total, we can add everything that is in our equity and liabilities, and it will give you our total equity and liabilities. So we are going to start with our shareholders equity of 1,440,000, add our non-current assets our non-current liabilities at 316,800 plus that current liabilities at 354,860, and it gives us 2,111,660 as our total equity and liabilities. And because this is a balance sheet, it means that this is the same amount that we are going to have as our total assets. So 2,111,660, and that would be our question 1 complete for a full 65 marks. To have YouTube recommend you more of my videos, be sure to click the like button and leave any questions that you have in the comment section below, and make sure that you subscribe so that you don't miss any of the upcoming uploads.